What is fractional ownership?
Commercial real estate, is a very lucrative sort of asset class. Number one, because it's a hard asset, so you have collateralized returns, and number two, because the returns are very competitive. So in a sort of market condition like today, when your fixed income returns, where your debt returns are sort of sub 6%, 6.5%, with commercial real estate, only from the rentals you can hope to achieve 8 to 10% monthly distributions of cash flow. And there are very few wealth products, for that matter, that give you monthly periodicity in sort of income. And the other avenue, of course, for commercial real estate is that it also becomes competitive with equities, because real estate appreciates with time as well. So when you take into account the appreciation as well as the sort of rental income of 8 to 10%, the return profile becomes more in line with that of equities, while your risk profile is in line with debt. However, due to the various barriers to entry, including a very high ticket price, commercial real estate, usually would be available only upwards of 30 crores, 40 crores. The kind of investor base that participates is limited to institutional funds, HNIs, and even HNIs, sometimes they don't want to have concentrated risk in one property to the tune of 40 crores. So, it's mostly your institutional funds. So taking that a step forward, we think that as a wealth avenue, as an investment avenue, the whole asset class has merit. And we think that fractional ownership as a concept is a good solution to, address these barriers to entry and sort of enable access to a much larger segment of the population.
Is commercial returns 8 to 10% across commercial asset classes, or is it only premium A-grade office spaces?
Sure. So, it really depends on the micro market. It really depends on the stability, the building quality, and, the vacancy rates. Like, for example, in a very mature micro market, like BKC in Mumbai, right? That the demand is there, the buildings are sort of built, and the risk is much lower as opposed to if you try taking an office building in the suburbs. So to some extent, you can say the returns are also reflective of the risk that you take. So, if I take a B-grade building in the suburbs, which has significant risk, I might say that, okay, I want a entry yield or a rental yield of about 11%. But if I go for a very, very strong asset, let's say with Deloitte as an anchor tenant for 12 years, 15 years, then sometimes sellers can even sell as low as 7%. So it's really commensurate with the amount of risk you're taking. But as a ballpark figure, for majority of the A-grade assets in this space, usually 8 to 9% is the current range under which properties transact, and 9 to 10%, depends on the stress of the seller. So there are many factors that sort of, come into play.
We have seen vacancy rates go up. So in that kind of variation, how does this fractional ownership work?
In a bull run, when everything is going in favor, pretty much every company does well. But, when you sort of come to a situation like today, it really sort of distinguishes the outliers from the, general pool of sort of options that one may have. So similarly in real estate, your A-grade buildings, which are tenanted to the likes of Facebook, Google, Amazon, these buildings face much lesser stress and are not very susceptible to market-linked, let's say, volatility. Primarily because, even for a tenant knows in these buildings that if they leave this building, they may not get a spot there 1 year from now, 2 years from now, because another tenant will move in and take up that space. So, there's the ITES space, warehousing space, data centers. These are the sort of segments that have kept up their demand. It's more the, you can say, not completely A-grade buildings, the B+ buildings, which were at slightly higher rentals, but because of the excess demand, in the office segment, they were maintaining their performance in a good market. But these buildings are the ones that are under relatively more stress in a time such as today. So number one, it's about quality, but yes. So we try and understand the dynamics of that building, that micro market. So just to give you an example, like we picked up Magarpatta in Pune. What we took into account are two things. Our investors should have a stable return today, but also in terms of the performance of the asset in the long term. So the reason why we chose Magarpatta is twofold. One, that it's an integrated township, 500 acres. So it's actually located in the heart of Pune. A lot of people who live in Magarpatta, when you ask them where you're from, they don't say Pune, they say Magarpatta. So they have that kind of pride. It's a great development, fully sort of developed, and it has a, from day one, a walk to work concept. So to that extent, it's a sort of insulated, office market whereby the vacancy rates are never really drastic. From day one, they've remained under 2%. And despite COVID, there hasn't been a single month we haven't got our rentals from Amagarpatta tenants. And the sort of mindset is same. If a tenant vacates over there, it's going to be very difficult for them, let's say 1 year, 2 years down the line when they're ready to get space again. So to that extent, the Magarpatta has maintained under 1.5%, vacancy rate. So it's a lot to do with asset selection and asset quality that helps mitigate the risk. But yes, the outliers, or you can say the A plus grade buildings do stand out and in fact perform better in times like this.
Isn't this the same bank of properties that the Blackstones, they are picking up too for the REITs, right?
Yes.
So there is a lot of aggregation happening of the same quality space, right? Which yields good returns, which has low vacancy rates and so on. So how will that push up the prices of these properties?
If you look at the market 10 years ago, right? So we spoke right now about 8% entry yield or entry yield expectations. But 10 years ago, when there was more regulation in place, when foreign money was, more scarce in India with respect to investments in CRE, if you see today, 8 to 10% is the expectation.
Yeah.
But if you sort of go back in time, 10 years ago, the expectation of a buyer would be about 12%, 13%. As a rental yield. Now, the rental yields are inversely proportionate to the price. Yeah. So, when rental yields come down, the price of a property naturally goes up. So what happened is that as the government started, promoting and facilitating foreign funds, and these funds started participating in India, the prices, of course, did go up. The main reason for that is a lot of these developed countries have a cost of capital of 4%, 5%. And they're deploying it in commercial real estate and achieving yields of, at that time, 12, 13%. So, that has sort of driven the prices up. But that also has sort of increased the quality. It's made the whole sort of segment more organized for that matter. Now you have the Blackstones, Brookfield, Hines, Keppel, these sort of organized players developing some of the most flagship developments in the country. So yes, commercial real estate will become more expensive, but it will also become far more, quality inclined as opposed to just delivery after delivery of projects.
Is this only for A-grade properties, or you see this rise also for B plus, smaller cities and so on?
So, all these funds usually only participate in your A-grade assets. You would have seldom heard of Brookfield or Blackstone going out and buying a B-grade property. However, there are certain players, I wouldn't say they're like large funds, but they're, very organized and very professionally run players who are in the business of buying, let's say, C-grade properties, B- grade properties, and then, upgrading, value adding to them, thereby converting them to a A-grade. So what they do is they look for a B- grade building, which has low rentals, but in a A+ grade micro market. Yeah. So, they focus on the dynamics of the micro market and enhance the property in itself to make it competitive in that, to that respect. But the Brookfields and Blackstones usually don't want to deal with development risk. They don't want to deal with, construction risk. So they actually come into a final product because for them, they're getting money at 4-5% abroad. Deploying it into a safer avenue of 8-9% does make sense.
So will you also look at, say, a Connaught Place, MG Road in Bangalore, Fort in Mumbai, where it is B or sometimes C grade properties, C minus also. But will you also look at those properties and upgrade and so on?
So I'll take a step back. Every vertical of commercial real estate, including warehouses, data centers, office spaces for that matter, and every grade of property, A grade, B grade, C grade. Now, each of them have a risk proposition to it, but each of them also have a return, projection to it. So it's a balance. It depends on an investor's risk appetite and his return expectation. Yeah. So it's not as though any is better or worse. It's just that investors need to be educated on the risk and returns. So to that extent, we do intend on, doing these value add projects, and we think that we are well positioned to do so, primarily because the parent company for Miley is Morphogenesis, and Morphogenesis is an established architecture practice. And, in fact, we develop for the Brookfield and Blackstones. So to that extent, I do think we are well positioned. But it's important, especially in a time like today, to first, convey the trust, to build that reputation, and deliver on our projections, to the investor base, and thereby taking it a step forward. But it's very important to not mask the risks and amplify the returns. It should be sort of conveyed.
How old are you as a fund?
We launched on about 1st of Feb or 15th of Jan actually, but then we relaunched 1st of Feb. And since then to now, we've seen very, very strong demand from investors. We are conservative in our approach, and what we like doing is investing alongside all our investors. Because our communication always is that, it's not like we're selling you dreams. There's nothing called high returns with no risk. What we try doing is we try understanding the risk, sort of preemptively mitigating them and optimizing the returns. So that's what we do. We think our asset selection is good. We are confident in it, and thereby we participate with our investors as an investor in each of our opportunities. So, an investment can turn out many number of ways down the line. But at the end of the day, since we have such strong faith in our asset selection process, we are there with the investors at the same price point that they entered, in their shoes, in any scenario, good or bad, down the line.
And what would be the ratio of investor investment versus vis-a-vis your investments?
Sure. So, we vary it asset to asset. We've gone as high as 35% personal investment. The minimum so far that we've done, if I'm not mistaken, is about 12.5%. But we do keep enough stake, also commensurate with the upside, because, it takes a lot of effort. A lot of these assets are worked on for a very long period of time, like getting an entry into Mega Max City, into Magarpatta. It's very difficult. You have only your institutional funds. Like for Magarpatta, we've in fact been pursuing it since late 2018. And, we closed it in 2020. So these things take a lot of relationship building, a lot of networking, understanding. So, when the seller wanted to sell, they knew that, we and them could form a good sort of buyer-seller relationship. So to that extent, these are all very relationship-based. Real estate is a relationship-based industry.
And where do your funds come from?
So we have been actively investing in real estate ourselves since actually 2010. We ourselves have a decently sized real estate portfolio, because what we used to do is, since we design most of the commercial real estate in the country, in fact, 165 million square feet of it, all of it predominantly A-grade for institutional and international funds. We have a good understanding, or at least believe we have a good understanding of the true pulse of a building. So to that extent, our commercial real estate portfolio has done exceedingly well. In fact, we haven't had a single day of vacancy in our whole portfolio since 2010. So that sort of demonstrates asset management as well as asset selection. So to that extent, we have a lot of investable funds because we have a lot of cash flow due to the rental income. So we sort of put our own personal wealth into these opportunities. It's a sign to the investors that, we are in it with you and we are truly there with them. So it's not as though we are raising funds one end and claiming it's ours and putting it another. So we don't do that.
Who regulates you?
So as of today, so the way real estate, has operated in the country, because assets are 40 crore, 50 crore, HNIs have traditionally formed consortiums. We are providing it a framework. We're providing it, you can say, professional management, but it's the same sort of structure. So we are actually compliant with the private limited and LLP regulations. In fact, we file all our documents with the ROC. We get audited. But as of today, because we are not under the purview of SEBI or RBI, so we cannot be regulated as of yet. But the way the regulations also develop, especially in a newly emerging category of investment avenue, is that once the category becomes large enough, once investors have demonstrated enough traction and interest in the space, at that point in time, SEBI does come in and set standards and regulations. One of the most recent examples is like the P2P lending space. For 3 to 4 years, it wasn't regulated. Once it became large enough, of course, SEBI had to step in, and now it's a very organized and structured framework.
How is it different from REITs?
We like to think of ourselves as to some extent, an asset management platform that is operating in the private equity real estate space as opposed to in the REIT space. So, in the REIT space, it's more about sort of, let's say, a whole portfolio of assets. It's more about sort of participating in commercial real estate in general. What we try and do is we try identifying an institutional grade property which is under market, try identifying a seller that, may require the cash flows and be willing to sort of give it at a good price to us. Opportunistic buy, for that matter. We get in, we sort of make a informed decision, a well-analyzed decision, and then our intention is to exit, let's say 4 or 5 years down the line, and like a private equity fund, give double-digit returns to our investor. Whereas in a REIT, it's more based on, equity-like speculation. A very, very good example is at the start of COVID, nothing in the fundamentals of the REITs changed. In fact, they maintained 99% rental collection. Yet their, the value or the stock price of these REITs fell by more than 25%. So, the more number of retail investors that there are, the more listed the product is, the more susceptible it is to volatility. So, real estate loses the essence of being an underlying hard asset when you have that level of volatility. So, of course, everything comes with pros and cons. Like you said, REITs are currently more regulated. They might have a higher degree of liquidation. But, again, returns are lower. Sort of your asset choosing is not as flexible. You're sort of exposed to a much larger portfolio. So the coexistence definitely, has happened in other countries. Each has its own space. Each has its pros and cons. And I think that even in India, not only coexistence, but also the synergy between fractional ownerships and platforms and REITs are going to be very interesting, because these REITs actually, or for example, your Brookfield and Blackstone, when they're setting up REITs, they're looking for a high quality portfolio to acquire. So, they might actually at the end of the day come to a fractional ownership platform, say that, listen, you have some great assets, do you want to do a bulk exit to us? So to that extent, the synergy, the coexistence, definitely, it's going to be there.
So you are earlier in the cycle than the REITs, right? You buy, you aggregate, you
yes.
nurture it, and then you can exit by selling it off to REITs.
Correct, because REITs doesn't want to operate at a 50 crore size, right? So we aggregate multiple 50 crore properties and create a 500 crore or 1,000 crore, exit for them. So we work side by side with them. And I mean, I think that there's a lot of scope which will be explored, which will be further, delved into as more REITs come into play, as more fractional ownership platforms develop. So I think it'll be a very interesting space going forward.
My guess is that there will be regulations.
In fact, I think regulations will do the whole industry good, because, when regulation comes into play, usually people think it's a negative sentiment. But, it actually increases investor confidence exponentially. So we are very happy if regulation comes. In fact, we applied for the SEBI Sandbox program. So we are trying, more than happy if it does come in, and I think it will do good.
Who are your investors?
Majority of our investor base is your professionals, your lawyers, your salaried individuals, entrepreneurs who are looking for a good, fixed income alternative. And because of the low yield, low debt, really the avenues of deployment of capital is limited. Further, what we've also witnessed is significant traction from NRI investors. A lot of these NRIs want to build a income stream in India. They have family in India. For example, we had a couple of NRIs who have parents in India, and they wanted to, send the rental to them to help them with their EMIs and monthly expenses. So to that extent, we have significant traction from NRIs. NRIs also have limited investment opportunities in India. So that market has really done well for us. But yeah, I think that we've seen traction from a very, very diverse set of investors, lawyers, engineers, CAs. In fact, we have a couple of techies, young techies who've invested with us. We touched, I think, 18 or 19 cities. So to that extent, I think that this product, the risk return proposition, is very attractive, especially for retail investors.
And how do you market yourself?
So, we market ourselves a lot. So we have a very high referral rate. So a lot of our existing investors refer us to their friends basis their experience. So we have a huge part of our investor base, which is actually basis the current investor referrals. We work with B2B partners. We've tied up with 100 plus distribution platforms, wealth platforms, IPCs. So we work with them across the board. Apart from that, of course, we have a digital first approach, and that's another avenue. But fractional ownership as a whole category has gained a lot of momentum in the last year and a half. Our knowledge center is not so much about quantity and blogs. It's going to be more of, you can say, a crash course into the different verticals of real estate. So we are going to have things about how you should do asset selection, the data that matters, more oriented on informing the investor, because if an investor is participating in asset class, if they're becoming a fractional owner of a building, they should understand how to evaluate one. Otherwise, all the hard work we do, they should be able to understand it and thereby make a informed decision.
What happens when things go wrong?
It's all about trying to make everything transparent to investors. At the end of the day, we can only take a decision on the facts that are present today. We can't really speculate on future things. But what we do is we try making a very informed decision, try our best to use data to preempt the risks, and accordingly put risk mitigation strategies into play. But our whole premise is that when an individual investor wants to invest in CRE, they do it ad hoc. We do it more professionally managed, and we do it every day. So an individual might not have that time, but we actively manage it. So we are not saying CRE is the best or worst. We're not saying any asset class is the best or worst. We're saying an investor should diversify their portfolio across asset classes. In CRE, we can help you make a better decision.
And what is the ticket size in multiples of?
25 lakhs for now. We are trying to work around it because we do want to lower it. But that being said, 25 lakhs is also an interesting amount because commercial real estate is not something that like an equity market that appreciates and depreciates on a daily basis. It requires patient capital. So usually people who invest, let's say 30,000, 50,000, they are not. That's not patient capital most of the time. Because it's an alternative product, new. We have to be also sort of reasonable with respect to expectations. So we've kept it at 1 year. Because real estate is not a product you trade daily, but after 1 year, investors are free to exit, as and when.
And what are how do you pay out to your investors? What is the
so we pay out in monthly rental distributions. So it's done as per the frequency that the tenant pays us.
And it is only based on rentals, or is there any other factor?
No, so it's only rentals. We have a security deposit which earns interest, so we pay that out. So any sort of income, sometimes there's car parking rental, we add that. So that's one form of income. The other is, of course, capital appreciation, which investors realize at the time of exit.
Thank you so much, Arvind.